Hi, you're watching Investor Insights, and in this video I want to discuss the issues with the stock market rallies. Now, it doesn't matter which stock market you want to look at, whether it be the US, the various ones in Europe, the ASX 200, it doesn't matter. This is relevant to all of them. And the fundamentals aren't there. The fundamentals aren't there to keep these valuations up so high. But even aside from that, you look at the leaders of this rally, and at the forefront are defensive stocks. And defensive stocks are basically companies that are mature, that don't really see too much room for growth, they don't really have too much expansion plans, so therefore any sort of earnings that they have, they plow back into investors via dividends. Growth companies are lagging. So growth companies are obviously the opposite of defensive companies. They are growing, they take their earnings and they look to grow either organically or through acquisitions, and that's how they grow their multiples. But in this rally, that's not really happening. You look at, for example, growth companies within our own index. You look at things like BHP. It's down at least 35% in the past 2 years. And yes, there's been a slight dead cat bounce of late, but it's still way down. If you got in at $50 a couple of years ago and it's now languishing at 32 or 33 bucks, whatever it is, I don't really care. Man, you would be in a whole world of hurt right now. You look at America. Even as recently as it's August now, last September, Apple reached an all-time high, $700. It's now languishing in the 400s. What's that telling you about the stock market rally? The Fed's stimulus measures have driven money out of the bond market, because obviously you'd have to be an imbecile to be investing in something, or I should say speculating in something that is only going to return you 2% nominal returns, and technically after inflation you're going to be behind. So why would you invest in those assets? So you would take your money out of the bond market, or actually not put your money in the bond market, and instead go and chase yields from defensive stocks. And that's what a lot of the stock market rally has been about, the chase for yield. And even within our own ASX 200, you look at things like Telstra. I mean, Telstra just a couple of years ago was trading it below 3. And now it's about $5. Now, at $3, Telstra pays 40 cents, including franking, a year. So on a $3 stock, that's what, 15% yield, including franking credits. And even at 5, it's still almost 10%. So that's what's propping up these stock prices. No, Telstra is not a runaway leader of innovation. It's not a tearaway stock because everybody wants its technology, everybody wants to be a customer of Telstra, everybody wants its products. No. To be quite honest, Telstra reeks as a stock. I mean, it borrows money to pay its dividend. It can do so with low rates at the moment. But when rates have no choice but to go up because inflation is going up, that dividend might disappear. Sorry, that dividend will disappear. It will be at least cut, because Telstra doesn't have the earnings to pay such a large dividend. And so, before you invest into the stock market, I'm not talking about speculators, you do what you want, okay? You're going to get crushed. But if you want to make sensible investment decisions in this stock market, you would really have to take a step back, because good undervalued stocks are far and few between. Everything is overpriced. I don't see any bargains out there. And if you call it investing into the stock market right now, you're crazy. I would rather refer to it as just speculating. Fear of failure, maybe, because everybody's making money, so therefore you should too. And just like your folks would ask you when you stuffed up as a kid, if everybody jumped off a bridge, would you follow suit? And in this case, everybody is. So if you want to be part of this big crowd of lemmings, and when they all fall off a cliff, you're going to die with the rest of them. I can't say when this investment climate is going to change. Stimulus can go for a long time. But as I've said time and time again, inflation will be the key. And when central banks have no choice but to hike rates, bond yields are going to skyrocket. Therefore, bond prices are going to crash. Stock markets are just going to get wiped. And this time, there'll be nobody to bail out the governments. I should say, there'll be nobody out there to bail out the responsible parties, which is the governments. So, if you're looking to be a long-term investor in this stock market, I'd be very wary and I'd be very skeptical.